IRS risk signals, very important. Sometimes an uncomfortable topic, but we have to go through it. Being in a payment plan is usually not a challenge, not a problem. You're in a payment plan, that means you're in good standing. When you start to go well in excess of $100,000, that's when it becomes more of a challenge, and it depends on the appetite and the threshold, the comfort level of the institution, bank, lender. That's at the bank, lender, institution level that they make that election, what the threshold is. A lot of times in my experience of many years doing this, it's about $100,000 where questions start to occur, although we've helped finance plenty of businesses that had around that amount or exceeded it. Again, case by case, state by state, bank by bank, program by program. That's how decisions are made in banking. So, IRS risk signals, liens, unpaid obligations for a series of years that are untended to, that become a lien. Not in a payment program which is in good standing, you have a tax lien or a state tax lien. These are challenges, these are impediments to funding. You have to make your tax obligations. And being in a payment plan is okay, and yes, that means that there's interest associated and they will charge you interest. It's not for free, they're putting you in a payment plan, but you're at least in good standing for your bank application. So important. So IRS risk signals, that's a very important one to understand the difference between being in a payment program, tax liens, state tax liens, federal tax liens. That's obviously a challenge and a deal breaker for many banks and lenders that are looking to that level. So that's important. And then of course it's irregularities. A risk signal, of course, or an auto cause for decline is when you produce a PDF, a tax return, that doesn't match the transcripts they pull. That's a problem. That's a concern from almost every bank, lender, institution. When they're looking at your application and they see that you've showcased a PDF that showed a particular amount of strength, there was a certain entity type, and then they pull transcripts and they see something that differs, that is going to concern them about the integrity, the accuracy of the remainder of your financials. And if you're lying on the personal tax return and showing not enough earnings, but you're living your life because you're trying to reduce tax liability, that becomes a concern. That's the risk signal. You're not paying yourself enough. You're always showing big losses. Or of course, that the transcripts, they don't corroborate what you've showed them and what you supplied in the PDF format. So 8821s and 4506Ts, you don't really need to know these. These are forms that allow them to pull and release your transcripts. The institution, the bank, lender, allow them to pull your transcript to reconcile and see, do they corroborate? Do they tie out? Are you showing the same returns and financial performance figures to us for our underwrite as you told the IRS? So those are big IRS risk signals that you need to be aware of and conscious of, and move on.
Learn the course for free at businesseligibility.com.